Welcome to the Wealth Without Wall Street podcast, your guide to understanding how to get out of the Wall Street rat race and start your own mailbox money lifestyle. Now, don't let these handsome Southern draws fool you. These financial minds are teaching our country to enhance savings, increase cash flow, and create passive income, all without the help of Wall Street. Are you ready to break through? Now here are your hosts, Russ Morgan and Joey Murray.
Welcome. This is the Wealth Without Wall Street podcast. Your host, Joey, the Italian Stallion Murray, joined as always by Russ, the idea guy, Morgan. Russ, do you have some no-dos over there or something I could take? I am about to fall asleep at the wheel here.
Look, I know that you guys just had that fifth baby, and it is getting a little bit hairy in the house. I can see you're a little bit sleep deprived, bro.
Yeah, I'm dragging. There's no question.
Hey, look, I cut my arm one day on the dog's cage trying to let them in, and it's got this pretty cool scar on it. I've started trying to figure out a good story I can use, like maybe back toward like my public school days or something, like how I like intercepted a
knife fight or something.
Yeah. So you need to take this and just think in your mind, I'm not sleep deprived because of a new baby in the house. I am training like a Navy SEAL.
Oh.
Are you with me on this?
Okay.
You know, like in Hell Week, the Navy SEALs, they will like only sleep at most 4 hours. Then they do like all this physical workout for like 20 hours a day or something like that.
Yeah. That sounds about right.
Yeah, you've been doing that part?
Yeah.
I mean, look, just go home, watch G.I. Jane. I think you and Demi Moore, you know, she cut her hair, that dark hair, shortcut. That's where you go. Like, just figure out, like, embody Demi Moore and G.I. Jane and apply that. I think it'll boost your morale.
I'm going with that. That's much better than the alternative of me falling asleep here at the mic. So I like it. But let's talk about really what keeps other people up at night.
Okay.
Maybe they don't have a newborn, but they're thinking, what if my strategy for income and retirement is wrong?
Well, and that's a big topic. We've touched on this a little bit in the past.
What if I run out of money?
If I'm climbing up this mountain, right? This mountain of working, accumulating money, creating wealth, whatever we're working toward, do I have 100% chance of getting down? Meaning, will I run out of money before I die?
And what does that mean? Do you have to start thinking, what age would I be if I had to start going back to work? Like, what would I do if I was in my 80s and had to go back to work?
Do I really want to get flexible with my spending? That was one of the things that we heard on this podcast is that, well, if you're willing to be flexible with your spending, what does that mean? Like, flexible, is that where I start adding some level of like dog food into my ground beef in order to, like spread that out? I mean, what's the flexibility there?
I don't think that's what he meant, by the way.
But
what we're talking about, actually, our interview with Dr. Wade Pfau, the doctor of retirement income, the professor of retirement income. Who else do you want to ask these questions about optimizing your retirement income so you don't run out of money?
Well, and at creating strategies actually to help us overcome those potential pitfalls that either exist because the market's diving when we start taking out money. That's a problem.
Absolutely.
Also, hey, how can I maximize legacy? Because I do want to spend as much money as I possibly can in retirement, but I still want to be able to leave money to the next generation. Well, we hear that all the time. Hey, I'm a little bit nervous of spending too much money in retirement because what if I run out, one, but also then I don't have anything else to leave behind.
Absolutely. And he even touched on the human aspects of investing, right? We've talked about it before. Do I get emotional at the highs of the market and buy too much and then it drops like a rock? Or do I sell at the bottom of the trough because I'm worried sick that it's going to continue to go down? Those are things that we have to address.
Well, and also, if we are going to continue to stay in a low interest rate environment, this 4% rule that everybody's following out there that we've already hit on before in the FIRE movement, how likely is that to continue to play out? And then also, how does these life insurance contracts play into this? And how are their portfolios designed to help us even in low interest rate environments? So lots of good stuff. I think you're going to like the interview. Just know Joey's a little bit over his head, not only with managing a fifth kid in the house, but also listening to Wade talk about math in economics and bonds and stocks. The Stallion, This is going to be a good interview.
Pull out your crayons so you can take good notes. Let's get down to the interview.
If you've been listening to our podcast, you're like, man, I love what you guys are talking about. I want to build passive income through one of these 5 pillars that you're talking about. But how do I do it? Stallion, tell them it is so easy.
It's so easy that we created the longest URL possible. So you may want to write this down. freecall.wealthwithoutwallstreet.com. Go to freecall.wealthwithoutwallstreet.com and you can set up your call with one of us. We're excited to talk to you. Welcome into the show. We have Wade Pfau, Dr. Wade Pfau, professor of retirement income at American College, in the studio today. Wade, we're so happy to have you, man.
Well, thank you. I'm glad to be here.
Hey, it's not every day that we have somebody that is literally a professor of retirement income. I mean, who else can say that, right? I mean, Russ, have we interviewed anybody else with that name?
No, I mean, we like to say doctor, just because maybe our days of watching, old Chevy Chase films or something like that. But we actually have a doctor in the room, and he can help us maybe solve some of these problems that a lot of the people as they reach retirement, the number one fear is running out of money. So if you've got that fear, today's podcast could be pretty good because we've got the guy who's done all the research on what you need to do in order to avoid running out of money. Is that right, Wade?
Yeah, that sounds right. And I've been looking I think I've got a unique job title. So if you do know another professor of retirement income, please let me know and I'll have to adjust what I say about it.
I know. See, that's the thing is like you put that on a business card, it's like mic drop. Like nobody's got that one.
Like the other day I was talking to a guy and he's a rocket scientist. So he literally is that guy that you say, I mean, it's not rocket science because that's what he does every day.
All right. So Wade, explain to me the 4% rule. Because this is, if somebody goes and they Google Wade Pfau, they're going to see 4% rule. What is the 4% rule?
Yeah, and really if you just Google about retirement, you're going to run across the 4% rule. It's a rule of thumb that was designed by a financial planner in the 1990s. Bill Bengen published an article in 1994 that provided a strategy for how you spend from your investments in retirement. And he said, if you plan for a 30-year retirement, you can, and you use an asset allocation between 50 and 75% stocks. He wants aggressive stock allocations. He actually says as close to 75% stocks as possible. Then you can take out 4% of your assets. So if you had $1 million at the start of retirement, just for example, you could take out $40,000 and spend that each year. That can grow with inflation, but spend $40,000 plus inflation each year in retirement, and you should not run out of money for 30 years. But you might run out of money.
No matter what the cycle is or whatever the market cycle is.
Well, yeah, he based it on looking at historical U.S. data and found that the worst case 30-year period since 1926 allowed you to spend just that 4% of your assets at retirement.
And then there was some kind of, as I've been doing research on this myself, then there was kind of a follow-up study by the Trinity group, the college out of Texas, where they kind of tried to figure out what that portfolio success rate was, and there was some adjustment to it.
Yeah, right. They were really just following the same methodology as Bill Bengen, but they looked at, well, if you use different withdrawal rates, if you had different retirement lengths, different asset allocations, what percent of the historical, different year periods would your portfolio survive so that you could spend at that level and not deplete the portfolio? And they basically had the same results. They actually used a different bond index. And so they ended up concluding that the 4% rule for 30 years works 95% of the time. But if they had been using the same bond index as Bill Bengen, they would have found the 100% success. But it's based on the same U.S. historical data.
All right, so you come into the picture. You've been you mentioned to us kind of a pre-show that you'd been in Japan looking at pension retirement rates and things like that. You came back, you started studying this a little bit. You've done the 4% rule and applied it to over 20 countries, I believe you said. What is it that you found while studying this?
Yeah, well, and that's how I got my start. I was living in Japan, wanting to move back to the U.S. I had this data set. It's another data set from Morningstar, like Bill Bengen used, but it's market returns for 20 countries. And I looked at, did the 4% rule work in other countries? And out of the 20, it worked in the US and Canada. If you look across all the countries, combining it all together, the 4% rule worked about 2/3 of the time internationally, compared to 100% of the time in the US. And I thought that was pretty compelling. Sometimes people didn't really find that very compelling. They said, well, who cares if it doesn't work in other countries? If you're in the United States, look at the US. But that just led me to start looking at other issues as well, and the impact of lower interest rates, the impact of higher stock market valuation levels, the fact that as people are living longer, 30 years may not be a long enough retirement horizon, the reality that there's investment fees on a portfolio. You don't earn the index market returns unless you are now. I mean, it's possible today if you're in very low cost index funds, but people might be using mutual funds that have expenses on them, and that's going to reduce the sustainable spending level. All these types of issues. Investors might mistime the markets, where there's this common idea that people tend to panic and sell their stocks after the market already went down, or get greedy and start buying more stocks after the market's already had a big run up. And all those kinds of behaviors are also going to reduce the applicability of something like the 4% rule. So in general, I became very concerned that just applying blindly this 4% rule as a way to spend from an aggressive investment portfolio may not work as much as the simple look at the U.S. historical data would suggest.
Well, and I think what you mentioned there is low interest rates, right? Because we've been in low interest rates for how long in the U.S.?
Yeah,
it's been quite a while now, since going close to probably 10 years at this point.
Yeah. And from the stuff I'm reading, I don't know, obviously you're studying this a lot closer than I am. There's not a whole lot of expectation for them to rise at any rapid pace in the near future. Is that right?
Yeah. The markets expect inflation to remain low. And in terms of the real interest rate, the after inflation, like when you look at TIPS, Treasury inflation protected securities that provide that inflation protection, there's no real compelling reason to think why TIPS yields might increase dramatically in the future.
So if we stay in a low interest rate environment, that 4% rule becomes even less viable. Is that what I'm understanding from what you're talking about?
Yeah, that's right. That when interest rates are low, that means bond returns will be lower. And so if you're trying to spend from bonds in retirement, that means your spending rate will be lower. Now, the 4% rule doesn't work if you're in just bonds.
Right.
In the 1940s, if you just invested in bonds, your withdrawal rate was as low as 2.4%. But then when you look at, stock returns, they should be lower to account for lower interest rates as well. If stocks returned at their historical levels when interest rates are low, it implies that people are getting a bigger risk premium. The idea that stocks will outperform bonds because they're riskier, they would outperform it by even more if they're earning historical returns when interest rates are low. And to the extent that not many people expect that risk premium to be higher in the future, you really should account for lower stock returns as well because of the lower interest rates. And that means lower returns, lower sustainable spending. It creates more risk for something like the 4% rule.
So tell me this, Wade. I mean, that when you took all this into account and you started to research this further, what sort of things did it drive you then to look into that maybe you wouldn't have otherwise looked into?
Well, yeah, then the next step from that, because I come from the investments side of the financial world, but this whole investment approach, it's really that trying to use an investment portfolio to fund retirement is very inefficient because you have to manage all this risk on your own, and there's this longevity risk. You don't know how long the money needs to last, and that's why this whole 30 years, it was meant for a 65-year-old planning to live to the age of 95, beyond your life expectancy, but you have to be conservative about that. You have to assume you'll live a very long time and then spend less to make that money last longer. And then the market risk, when you're taking distributions from your investments, that enhances market risk. It makes market risk have a bigger impact because you if the market is down, to meet your spending goal, you have to take a bigger percentage of what's left, and that can dig a hole for the portfolio that's more difficult to recover from. And you're trying to manage that risk on your own, and it leads you to have to spend less as well. So then I just looked for alternatives. Well, what could you use as an income tool outside of an investment portfolio? And that led me in the direction of looking at things like annuities, like reverse mortgages, life insurance, just different kinds of tools or different ways to even think about an investment portfolio to help manage these risks and to have ways to spend more than you're able to spend if you're really worried about outliving your wealth, and therefore plan to live to age 95 or 100 and plan for very poor market returns in retirement and so forth.
Well, Wade, I come from an investment background, and I remember the first time I started accepting and adopting some of those same principles, using annuities or using life insurance as a means to helping my clients create wealth and create greater income streams in retirement. That was a very difficult thing, especially to share that with my peers, because we were clearly investment people. How's that been taken in your area, in your arena, when you started bringing those sort of things up? As I sit here in the state of Alabama, proudly wearing my Auburn shirt in the middle of March Madness. Like, did you become the Auburn fan in the middle of a big state of red Alabama? Did you experience those same sort of things?
Yeah, I mean, that can happen because financial services is really divided. And so when I would go to meetings for financial advisors who tended to charge based on the amount of assets they had under management, they really don't like annuities because they take away from the amount of assets they're able to manage, and therefore take away from what they're able to charge the clients. And so they had a very clear bias against annuities, and I would get tomatoes thrown at me and so forth. But as the years have gone on, I think the situation is getting better, that there's a growing appreciation that what I was talking about, where with the investment portfolio, you have to keep all those risks yourself. So you have to plan for a very long life and for poor market returns, and therefore have to spend less. But with something like an annuity that provides lifetime income, you're able to pool that risk, and you're able to spend at a higher level from the asset base, because you can spend based more on an average outcome, average life expectancy, average market returns, because then those who live longer will receive this additional spending power from the risk pool, subsidized by those in the risk pool who didn't live as long and therefore didn't have as an expensive of retirement. And that can really lay the foundation for a better retirement outcome, or for being able to meet spending goals with less assets, being able to then invest other assets outside of the annuity more aggressively, and then not even necessarily hurting their legacy, perhaps even enhancing their legacy as well, if they have a longer than average retirement. So I think there's growing appreciation that type of approach can lay a better foundation for retirement income.
Well, and I know that, Joey and I came across a white paper that you had written actually with one of the insurance companies we do business with. It was titled Optimizing Retirement Income by Combining Actuarial Science and Investments. And I think that you kind of laid out in there how using life insurance and annuities does both enhance income and enhance legacy. Share just a few of the findings that paper really that you discovered and were able to lay out. And we're going to, by the way, we need to put a post on this on the show notes, Joey, to make sure we share this, because I think this was a really cool article. So what were some of the major findings from that article, Wade?
Yeah, well, so before that article, I'd already been really seeing the value of annuities. And then in that article, looking at, well, how can life insurance fit into all that as well? So thinking about somebody who's still far from retirement, and the two case studies were for 35-year-olds and 50-year-olds. If there's this idea of buy term and invest the difference. When you're young and you have a family, you need life insurance for helping your family in the event you pass away and no longer provide income to support the family. So the investing world has the idea you use term life insurance with a lower premium that provides you the life insurance to protect your family from losing your income. And you don't need life insurance after retirement. You can put more into your investment account because the term life insurance has a lower premium.
I've never heard that,
and
by
I
the way.
compared that to
Yeah,
Yeah, that's unique.
new.
Yeah, that wasn't something I'd ever heard before. Keep going. I'm sorry.
Right. Well, then there's something like a permanent life insurance approach. So, for example, whole life insurance, where the premium will be higher because you're not just getting the life insurance for a limited period of time, but for the remainder of your lifetime. And that kind of life insurance also creates a cash value. So you have underlying assets that the insurance company is investing in a very high quality bond type portfolio. And so you have the cash value growing, you have the permanent life insurance, the premiums are higher. And to not compare apples and oranges, I start at that point where you have these funds set aside. You're going to pay for your life insurance and the taxes on that, and then whatever's left, you're going to put into your 401k. So by using the permanent life insurance, the premiums are higher. You're putting less into your 401k, so that when you get to retirement, your 401k balance will be less. But then looking at building a retirement income strategy around that, an investments only strategy where you take your bigger 401k balance, but then try to apply the 4% rule or whatever reasonable, sustainable spending rule you want to apply to that, and comparing that to other approaches where you use part of the assets to buy an annuity, or you think about you might buy a single life annuity, even for a married couple, because you have then the permanent life insurance that will provide the death benefit that for the single life annuity would stop the annuity payments, but then the family receives the death benefit that they can use to then continue to sustain that retirement income. And that sort of approach I found to be very effective, where you have the life insurance, you have the single life annuity, and you have the investments as well, because you don't put all the assets into the annuity, you still have the investment portfolio. And when I look for efficient retirement strategies are those that let you spend more and or preserve a larger legacy. And if you can find an asset or a strategy that lets you spend and doesn't hurt legacy, lets you potentially have a larger legacy as well, then that's a more efficient strategy. And I found that these integrated strategies with life insurance, annuities, and investments were more efficient. They let you spend more and have more legacy across, much better than average odds. I'm doing this with randomized return simulations. And so it's not in every single simulation that the outcomes are better, but the odds very much fall in your favor of having better combined retirement outcomes with those integrated strategies versus just investments on their own.
That's really important, I think, for people to hear and understand, is that these things are not all like baby out with the bathwater. Like I think that's a misconception sometimes when people hear our podcast. They think, well, if I'm going to do this whole Wealth Without Wall Street thing, that means I can't have money in the market and I need to like jump all in. And that's not the case, right? We are not going to manage their money, but we definitely don't require them in any way, shape, or form to get rid of it. Now, but on the other side of that, I do want to get your expert opinion on this. A lot of our clients and the people that we're serving do not have money in markets already. They're entrepreneurial. They've got more of their cash available. A lot of them are using life insurance today to make investments like real estate and lending and other things that would be outside of the markets. So talk a little bit, and I know you can't be as direct as you were in the white paper because you have all the data, but just in general, somebody's investing in those types of assets and not in the market. How does that affect this whole, I'm going to call it the covered asset strategy that you mentioned with the annuities and the insurance? How would you respond to that?
Yeah, and in that regard, I'm very much an advocate of the stock market and using the stock market as part of the investing strategy. Despite it seeming like I'm pessimistic about things like the 4% rule, I see the value of stocks. I wrote an article. It's called Retirement Income Showdown, the risk premium versus risk pooling, which is about using stocks versus using annuities in retirement. Bonds don't give you any shot at the higher spending power. It's kind of bonds are the baseline. You can spend from bonds, but the amount you can spend is going to be less than if you seek higher returns from the stock market, or if you seek the subsidies and the risk pooling from the annuity. If you're going to just be in bonds or kind of lower yielding fixed income, safer type of investment assets, then the story for bringing insurance into the mix is all the more stronger, because if you're not using stocks, you don't have anything to compete against insurance. Insurance with the annuities and whole life insurance, that is also investing your money in bonds. The insurance company takes your premiums and invests them in their general account, which is generally a pretty high bond allocation, but a more diversified. You're able to get higher yields because you have longer term bonds, more diversified across corporate bonds that are offering higher yields, perhaps less liquid bonds that you wouldn't really be able to hold on your own as a household. So it's a pretty good yield on a bond portfolio, plus the additional tax deferred advantages and potential to get the money out without paying taxes on the money that comes out of the cash value, or if it's received as a death benefit, that's that tax-free benefit. So you really can have competitive returns on your insurance relative to just holding that money in bonds. Plus, bonds by themselves are just not competitive with the value of an annuity, providing that income protection and that risk pooling feature. So if you're changing, in the analysis, I assume people were also comfortable holding stocks. I haven't done the analysis if they don't hold any stocks, but the story I know will just become all the stronger that an integrated strategy, in this case, annuities, life insurance, and a bond portfolio is going to outperform almost surely a bond portfolio by itself.
Yeah, well, and I had that question posed to me one time. If bonds are going to potentially perform poorly and the insurance company, like, as you mentioned, is made up primarily in a bond portfolio, how is that going to impact me? But what I heard you say is that the insurance companies are holding different mixes of bonds that just the average family just can't. Is that right?
Right. Well, they're able to better diversify, and because they're able to better match the maturities on the bonds to the expenses that they know they have to make for annuity payments or for life insurance payments, yeah, they can hold longer term, more diversified and less liquid bonds than households, and therefore your premiums are earning a higher yield on the general account of the insurance company than you could probably really expect to earn with your own bond mutual funds on your own outside of the.
So basically the white paper that you wrote with One America, it was basically a covered asset strategy. Really quickly, and I know you've talked about it, but if someone heard that term, they may not be able to piece that back together. What is a covered asset strategy? And the second question I want to follow up on is that I believe there's a second white paper coming out. I'm interested in hear that, but explain for someone who's listening, just explain it for the stallion, because he's still trying to figure this out too.
Yeah, I'm a little slow.
What is a covered asset strategy?
Okay, so the covered asset strategy is you get to retirement, and a lot of times people are kind of scared of annuities. They're not comfortable holding them. Or if we're talking about a married couple, even if they do buy the annuity, they feel like they should buy it in a joint life version that provides the income for as long as at least one of them is still alive. And that's going to pay less than a single life version that only pays for the lifetime of one individual. So the covered asset strategy is you get to retirement with permanent life insurance in place. So you have the death benefit from the life insurance available for one of the spouses in that couple, and that provides them the comfort to go ahead and purchase an annuity as well, and even to do it on a single life rather than on both of the individuals, which has given them more bang for their buck in that regard. And they're comfortable doing that because the death benefit will replace that asset. That's the covered asset. The life insurance will replace the premium that went to buy the annuity when that individual passes away, and therefore provides the survivors funds to either buy a new annuity or whatever the case may be at that later time in retirement. And just having that life insurance in place helps the individual feel more comfortable following through with the decision of purchasing an annuity as part of their retirement income plan as well,
and so
versus just using the investments for everything.
Yeah. And so now you've moved to like a second white paper that is on sequencing risk? Is that what I understood from our pre-discussion?
Right. Yeah. Well, it's at the end of the day, there's 4 ways to manage sequence risk, and this other paper is about buffer assets, which is one of the 4 ways. Quickly, the 4 ways to manage this sequence risk, which is where you're more vulnerable to the market returns that happen early in retirement. You can spend less. You can be flexible with spending, so you reduce your spending after a market downturn. You can develop strategies that have less exposure to the market volatility than that 50 to 75% stock allocation, or you can use a buffer asset. And this second paper is about the buffer asset. So buffer assets are assets held outside the investment portfolio that are not correlated with the investment portfolio, that do not lose value when the stock market is down, that you can then draw from temporarily to avoid selling your portfolio assets at a loss and to give your portfolio an opportunity to recover so that you can then later resume taking distributions from the portfolio. But that can really help to manage that sequence risk, because rather than having to sell a bunch of your assets to support your spending after a big market downturn, you just skip taking the distribution from your portfolio that year. You give your portfolio the opportunity to recover. You instead take that from the buffer asset. And the cash value of a whole life insurance policy is a buffer asset. Cash value is not related to the stock market, and it's protected not to decline in value. And so it provides this source of funds that you can use on that temporary basis to support spending without a portfolio distribution. And it fits into a retirement strategy as a way to help manage that sequence of returns risk. Can support a higher distribution rate from investments because you have the flexibility to skip some distributions, and can again then, by helping to manage that sequence risk, helping to protect the investment portfolio, can help you to support the same spending with a higher legacy at the end, or to support more spending with a potentially same or larger legacy. It lays that foundation as well for a more efficient retirement outcome.
So the way I've seen this illustrated in the past is, again, I'm sharing this with Joey. Sometimes he needs things broken down really simply. Wade,
I need pictures. He needs to draw pictures with crayons sometimes.
So Joey, this is how that works. If you have, say, $500,000 built up in your life insurance contract and you're taking out $100,000 a year to live on, and your investment portfolio experiences a negative return, instead of taking out money in that year or the following year, you can correct me, Wade, I think it's the following year in most of the scenarios I've seen, because you don't know the portfolio experienced a negative year till to the end, is that then you take out that $100K instead of out of the portfolio the following year, you take it out from that volatility buffer, from that whole life contract. So then it gives your money inside the portfolio a year to, in essence, rebound. And in most scenarios, I guess you've run the portfolio typically rebounds the year after a downturn. Is that what you're seeing, and why the volatility buffer tends to be a good fit there, or what's the statistics on that?
Well, yeah, I mean, in U.S. data historically and around the world as well, if you have a big market downturn, usually within a couple of years, the market's recovered and you're back on your way. We see that after the financial crisis in 2008, where if you could have held on for a couple of years, you're recovering most of those losses.
But when you're taking money,
asset,
yeah,
when you're taking money out, it's a big problem. But if the buffer asset lets you avoid taking the money out until that portfolio recovers, then you're back on track with that plan.
Yeah, we need to do a video on that, Joey, and share that on a link, because I think that's a good visual to see, because I know that was really helpful when I saw it. Well, Wade, thank you for coming on the show and sharing about this. And I'm really looking forward to that second white paper that's going to share the volatility buffer. We're going to share this white paper in the show notes. We'll probably maybe even do a little teaser video showing exactly how that volatility buffer plays out over time, just to draw some interest to that. And just thank you for your research in this area. Like you said, you are unique. We believe that we are the niche within a niche. I mean, there's not a lot of people out there focused on building passive income streams using life insurance. But then you have even one-upped us by having a retirement income planning designation there. That's not something that everybody out there is doing, especially being a professor in it. So thank you for coming on the show. Thank you for what you're doing in the financial community. And if you ever need somebody to collect the tomatoes thrown at you, I'll send the stallion. He loves Philadelphia. He's run the stairs before. He's glad to come up and be a part of that, just to take those tomatoes. So that
I like tomatoes.
Great.
I like tomatoes. Absolutely.
Well,
All right.
thank you, guys.
This has been the Wealth Without Wall Street podcast. Don't forget to subscribe to the show to break free of the Wall Street mindset and begin building wealth on your own terms in places you understand, so that your wealth will never run dry. See you next episode.